Thanks for clicking. Canada's fixed mortgage rates are seeing some downward pressure on the economic uncertainty coming out of the United States, down well over 3% since Friday. While the Bank of Canada's most recent rate decision offered no help on the variable rate front, fixed rates, should this drop in bond yields hold, might be getting some relief sometime soon.
It was the least I could do.
Yet, as we'll see today, this drop in rates could very well prove to be short-lived, as persistent inflationary pressures coming out of the United States, along with persistent policy chaos and the deluge of debt about to hit the Treasury market, showing us that, as it's been for the past few years, the focus should not be on the Bank of Canada, but rather events emanating out of the United States. So what I want to do today is go over what's going on in the Treasury market, which is pushing mortgage rates down lower, take a look at why this could very well be short-lived, and then discuss some implications for us here in Canada. As we'll see today, and as we're all well aware, U.S. policy uncertainty is causing some real gyrations in the market, which has a real impact on us here in Canada. We will obviously continue to track events emanating from down south and how they impact us up north. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into the bond market. Onto the bond market and Canadian fixed mortgage rates. As mentioned, yields in the United States, yields on the 10-year Treasury bond, have been plummeting, nearly 20 basis points since last Friday, on weaker than expected U.S. job data. The U.S. got its job report on Friday, showing that it only added 73,000 jobs in July, the worst growth rate since the pandemic, and also added 258,000 less jobs in May and June than was previously thought. The stock market plunged in response to the jobs data, with traders moving money out of stocks and into bonds. And since, as we've talked about so many times on this channel, a bond's price and its yield are inverted, as more money moved out of stocks and moved into bonds, bidding up their price, the yields on those bonds plunged. Yields on the 10-year Treasury plummeted 20 basis points since Friday, and as a partial result, the yield on the 5-year Government of Canada bond went along for the ride as well. And as always, if the Government of Canada is paying less to borrow money, that means that you and I will pay less to borrow money as well, so we should start to see some relief on fixed mortgage rates once the banks finally pass on those savings, usually in about a week or two.
You first.
No, you go first.
I see nothing.
So, the U.S. economy is much worse than people thought. Traders are now expecting rate cuts coming from the Federal Reserve. They moved money out of the stock market into the bond market, bidding up bond prices, sending yields lower, which in turn lowers the cost of borrowing for the Government of Canada, which lowers the cost of borrowing for you and I. But there are a few reasons to think that this drop in yields could be temporary. First and foremost, rising inflationary pressure in the United States due to the Trump tariffs. As we've talked about before on this channel, investors, lenders fear inflation almost as much as they fear default. Really a distinction without a difference. If U.S. inflation is going up, that means that that money that they lent to the United States isn't going to be worth as much by the time that it's returned, and as such, they're going to charge the United States a higher interest rate to lend it money. Second, and related in response to that 258,000 job data revision, President Trump has fired the Bureau of Labor Statistics chief, saying the revisions were rigged in order to make Republicans look bad.
Okay.
And on this, we do have a few ironies. We've all seen the president's attacks on Federal Reserve Chair Jerome Powell over the past few weeks and months, as he's tried to goad the Fed into lowering interest rates to help the United States service its debt, which is a bit counterintuitive, as this data revision gives the Federal Reserve the pretext that it needs to cut rates in September, and then the stats chief gets fired for it. Which, like I said, is counterintuitive at best, as we've all seen here in Canada, as we've talked about on this channel for the past few years. Those rate cuts do not come unless we get the weak economy along with it. You can't be too late to cut if the economy is doing fine. Further, as noted by the Financial Times, the fall in the jobs numbers was due in large part to a lack of government hiring, a project undertaken by Trump via Doge, meaning the BLS commissioner got fired over the success of Trump's own initiative.
We're all fine. Everyone's fine.
Regardless though, the firing is raising concerns about the integrity of the data being produced by the United States. If investors can't trust the data coming out of the US, then according to Morgan Stanley, then they could demand more yield compensation, meaning if they don't trust the US data, then they don't know if they're getting real returns, they don't know what to expect in the future, and as such, they could demand more to let the United States borrow money. Now, obviously, there are always problems with government statistics. I don't think anybody believes the numbers coming out of Stats Canada. But the numbers, nonsense though they may be, are at least consistent nonsense. The same metrics that told us inflation was at 8 are the same metrics that are now telling us inflation is at 2. You can't just change your opinion on the source because you don't like the data it's producing.
I can't too.
Regardless though, and again, related, the problem with the data, the problem with the trustworthiness of US data is only compounded by the fact that Trump is about to get one of his people on the FOMC, with Trump having previously said that he only would nominate those that support interest rate cuts. So you've got a central bank becoming increasingly pliable to the political whims coming out of the executive, while the data that central bank relies on is becoming increasingly called into question. If investors see the United States and or the Federal Reserve itself acting in a manner that will provoke further inflation, yields could surge ahead further, which would, as we've seen, as it always has, put upward pressure on Canada's own bond yields, which would push up our fixed mortgage rates. And absent printing money, the United States can't do anything to stop that. As we've seen, the Federal Reserve has cut interest rates by 100 basis points since September, yet the yields on the 10-year are still up 60 basis points. Central banks, the Federal Reserve, the Bank of Canada, can control short-term rates, they can control variable rates, but they can't control long-term fixed rates absent the money printer. Those are controlled by the market. And then the third big headwind for Canadian mortgage rates, as it always is operating in the background, is the US debt, with yields already up on Tuesday morning as investors continue to worry about the amount of US debt that is coming to the market. While the US is continuing to fiddle on how it borrows its debt, investors are continuing to worry about how much debt is coming to the market. And as we've seen time and time again, a weak auction is enough to send US yields back up surging. So, in summary, we've got the entirely predictable tariff-driven inflation emanating out of the United States, while the president attempts to exert political control over data production, and probably the central bank, and perpetual concerns about US debt levels, all pushing up longer-term yields in the United States, which can and will push up fixed mortgage rates here in Canada. And look, I've been talking about the US debt and its impact on Canadian mortgage rates on this channel for at least the past few years. And we're starting to see this play out in real time. The president is adamant that the Federal Reserve cut rates despite what was thought to be a booming economy, but he's doing so not so much to relieve pressure on the consumer, but to relieve pressure on the US government vis-a-vis its debt burden. This political pressure on the Federal Reserve, this manipulation over data production, and I would argue even the tariffs themselves, are all symptoms of an overarching problem. That is, the unsustainable structural nature of US debt.
Have you considered a reverse mortgage?
I would argue, and although this is a much longer video for a much different time, I would argue that the United States is suffering from imperial overreach, which we've seen time and time again throughout histories for millennia and millennia. Which means these elevated interest rates, absent a major reduction in inflation, absent the removal of these tariffs, or a major economic contraction, or the money printer, these elevated mortgage rates aren't going away anytime soon. With that said, we will obviously continue to track these events coming out of the United States and how they impact Canada's mortgage market on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.